Dubai, a city that, just a few decades ago, was mostly desert, and today stands as a global symbol of ambition. Skyscrapers, piercing the clouds, artificial islands, shaped like palm trees, luxury apartments selling out before the foundations are even poured. But here's the question nobody can ignore. Is Dubai's property boom sustainable growth, or are we watching another bubble inflate in real time? Before we dive in, make sure you hit like and subscribe. On this channel, we break down global wealth trends, real estate, and financial shifts in a way that actually makes sense. No hype, no fluff, just perspective. Now let's talk about Dubai. Over the past few years, Dubai's property market has been on fire. Record-breaking transactions, billion-dollar months. Investors from the United States, the United Kingdom, and Australia are pouring money into off-plan projects like it's a golden ticket. And at first glance, it makes sense. No property tax, no capital gains tax, high rental yields, often between 6% to 9%, sometimes even higher in short-term rental zones. Compare that to London, New York, or Sydney, where yields are squeezed and regulations are tightening. Dubai feels like a playground for capital. After the pandemic, the city positioned itself brilliantly. While much of the world was locked down, Dubai reopened quickly. Money moves where it feels safe and rewarded. And Dubai made investors feel both. Between 2021 and 2024, property prices surged dramatically. In prime areas like Palm Jumeirah, downtown Dubai, and Dubai Marina, values climbed by double digits year after year. Ultra-luxury properties, the kind priced above $10 million, saw some of the strongest growth. But here's where things get interesting. We've seen this movie before. In 2008, Dubai's real estate market crashed hard. Property prices fell by nearly 50% in some areas. Projects were halted. Investors panicked. The global financial crisis exposed how over-leveraged and speculative the market had become. So the real question is, what's different this time? Supporters argue that today's boom is built on stronger fundamentals. Regulations are tighter. Developers are more controlled. Mortgage caps limit excessive borrowing. Banks are more cautious. Unlike 2008, a significant portion of buyers today are paying in cash, not speculative flippers using maximum leverage, but wealthy individuals parking real capital. That matters. But skeptics see warning signs. Supply is rising fast. Developers are launching new projects almost every week. Off-plan sales are dominating the market again. When cranes fill the skyline, it signals confidence, but it can also signal overbuilding. And real estate markets don't collapse overnight. They overheat quietly. Let's zoom out. Dubai's population is growing rapidly. The government aims to push the population toward 5.8 million by 2040. Infrastructure expansion is aggressive. Tourism remains strong. The city is diversifying into tech, finance, and green energy. These are long-term growth drivers. But here's the tension. A large portion of Dubai's demand comes from foreign buyers. That makes the market global, but also vulnerable. If global liquidity tightens, if oil prices swing dramatically, if geopolitical tensions rise, foreign capital can exit as quickly as it entered. And unlike cities such as London or New York, Dubai doesn't have deep-rooted local demand, absorbing every cycle. It's dynamic, it's agile, but it's also sensitive. Another layer most people ignore? Currency risk. Dubai's currency is pegged to the US dollar. For American investors, that's comforting. For UK and Australian investors, exchange rates can significantly impact returns. A strong dollar can boost gains or wipe out profit margins. So what are we really looking at? On one hand, you have genuine economic transformation, visionary leadership, pro-business policies, a tax-friendly environment, global migration of wealth into stable hubs. On the other hand, you have rapid price appreciation, rising supply pipelines, and heavy reliance on international money flows. The line between sustainable growth and speculative bubble is thin. And here's where it gets even more complex. Because bubbles aren't just about numbers. They're about psychology. When everyone believes prices only go up, when influencers post penthouse tours daily, when off-plan launches sell out in hours, when buyers fear missing out more than they fear losing money. That's when markets start behaving emotionally, and emotional markets can be dangerous. But at the same time, dismissing Dubai as just another bubble ignores how much the city has matured since 2008. It's not the same Dubai. The question is, has the market matured faster than the hype surrounding it? Because right now, the cranes are still moving, the sales offices are still packed, the headlines are still optimistic. But beneath the surface, the real story isn't about whether prices are rising, it's about whether they can keep rising without breaking something underneath. Because when markets break, they don't send a warning email first. They shift quietly. Sales volumes start slowing before prices do. Discounts begin appearing in private negotiations. Developers extend payment plans. Incentives get sweeter. First, global interest rates. Even though many buyers in Dubai pay cash, liquidity still matters. Risk appetite shrinks. Luxury real estate is usually one of the first sectors to feel that shift. Second, oversupply. Dubai is ambitious. That ambition is its strength, but it's also its risk. Thousands of new units are scheduled for delivery over the next few years. If supply outpaces real end-user demand, rental yields compress, vacancy rates rise, and investors who bought expecting constant appreciation start rethinking their strategy. Third, geopolitical stability. Dubai thrives because it feels like a safe hub in an unpredictable world. But global capital is emotional. If confidence shakes, whether from regional tensions or global financial instability, the flow can slow quickly. Now here's the twist most people miss. Even if price is correct, that doesn't automatically mean bubble. Real estate markets move in cycles, booms, consolidations, corrections, recoveries. The real question isn't whether Dubai will experience volatility. It's whether the underlying economic engine is strong enough to absorb it. Let's look at fundamentals again. If you're an investor from the US, UK, or Australia watching this, understand this clearly. Dubai rewards strategic patience. It punishes emotional momentum. Ultra-luxury beachfront villas may continue appreciating because supply is naturally limited. Prime areas with strong tourism and business demand may remain resilient, but mid-market off-plan units launched at peak hype pricing, those are far more vulnerable if sentiment cools. And sentiment always cools eventually. So, is Dubai in a bubble? The honest answer is more nuanced than most headlines suggest. It's not 2008. The financial system is stronger. Regulation is tighter. Cash buyers dominate. The government actively manages growth and transparency better than before. But is it overheated in certain segments? Possibly. Are prices rising faster than income growth in some areas? Yes. Is supply expansion aggressive? Absolutely. The difference between sustainable growth and a bubble often comes down to one thing: leverage and expectation. If buyers expect 20% annual appreciation forever, reality will disappoint them. If buyers expect normal cycles, moderate corrections, and long-term value creation, Dubai could continue evolving into one of the world's most powerful real estate hubs. And here's the bigger perspective. Cities that attract global capital don't disappear. They adjust. London adjusted after 2008. New York adjusted after the pandemic. Sydney adjusted after tightening regulations. Dubai will adjust too. The desert city has reinvented itself before, from oil hub to tourism powerhouse, from trade center to global financial magnet. The real risk isn't that Dubai collapses. The real risk is entering without understanding the cycle you're stepping into. Because wealth isn't built by chasing heat. It's built by understanding timing. So when you hear the word boom, don't just ask how high prices are going. Ask how sustainable the demand is. Ask who's buying end users or speculators. Ask whether yields justify valuations. And most importantly, ask whether you'd still hold that property if prices paused for 3 years. If the answer is yes, you're investing. If the answer is no, you're speculating. Dubai's skyline will keep growing. Cranes will keep moving. Headlines will keep flashing record-breaking numbers. But smart capital doesn't chase headlines. It studies cycles. And right now, Dubai stands at a fascinating crossroads, not fragile, not invincible, but tested by the very success it created. The boom is real. The opportunity is real. The risks are real too. The question is, which side of the cycle will you be on? If you found this breakdown valuable, make sure you like this video and subscribe to the channel. We analyze global markets, real estate trends, and wealth shifts so you can move with clarity, not emotion. And until next time, stay strategic.